If you're like most investors, you want a good deal on your stocks. You want to enter the market at just the right time. Buy low, sell high. Since market highs and lows are relative, how can we ever know the perfect time to jump in? Maybe you recently received a bonus, an inheritance, or just have some extra cash you want to put to work. Now, you got a choice to make. Invest it all at once or spread it out over time. This is a dilemma that we all face, and that's what we're going to explore today. By the end of this video, you'll have a clear understanding of which strategy might be the best for you, and I'll give you my expert opinion on which strategy I actually recommend for my clients. I'm Jeremy Chambers, certified financial planner and founder of The Hourly Advisor, and today we're discussing lump sum investing versus dollar cost averaging. First, let's talk about lump sum investing. It's pretty straightforward. You take a lump sum of money and invest it immediately. By putting your money to work right away, you give it the longest amount of time to grow. Let's take a look at an example. Let's say you invested $100,000 in the Vanguard Total Stock Market ETF 20 years ago. Even with significant market events like the 2008 financial crisis and the 2020 global pandemic, your investment would have still grown substantially. The average annual return of the Vanguard Total Stock Market ETF has been roughly over 10%, with dividends and capital gains reinvested at the time of this recording, which means your $100,000 investment could have grown to over $740,000 by the time of this recording. This illustrates the power of compounding returns and staying invested over the long term. One important factor to consider is when you invest. If you invest a lump sum right before a market downturn, you might see significant losses initially. For instance, if you had invested a lump sum of $100,000 right before the 2008 financial crisis, your portfolio would have taken a significant hit. However, the key to success with lump sum investing is to stay invested and not panic sell. Historically, the market has always rebounded, and those who stay the course tend to come out ahead. After the 2008 crash, the market rebounded strongly, and investors who stayed invested saw significant gains in the following years. While lump sum investing can be highly effective, investing a large sum of money at once without knowing what the future holds can be intimidating and emotionally challenging. The fear of market volatility and potential short-term losses can deter investors from adopting this strategy. It's crucial to be aware of the risks and have strategies to manage them. Diversification is key. By spreading your investment across different asset classes, like stocks, bonds, and cash, you can mitigate the risk of any single investment performing poorly. Additionally, having a long-term perspective and being prepared for short-term volatility can help you stay committed to your investment plan. It's also beneficial to have an emergency fund in place to avoid having to liquidate investments during a market downturn. If you're unsure about lump sum investing, dollar cost averaging, or DCA for short, might be a better strategy for you. Dollar cost averaging is an investment strategy where you divide your total desired investment amount into equal parts and invest those parts at regular intervals over a specific period of time. The most common strategy is to invest every month over 12 months. Since you're spreading your investments over time, this means you buy more shares when prices are low and fewer shares when prices are high, averaging out the purchase cost of your investments over time. This strategy can be especially beneficial in volatile markets, as it minimizes the risk of investing a large sum just before a market downturn, and over time, this can lead to a lower average cost per share. Let's take a look at another example. Let's say you had the same $100,000 to invest 20 years ago, but instead of investing it all at once, you decide to dollar cost average instead. Starting in August 2004, you invested $8,333 each month for 12 months. By the end of those 12 months, your balance would have been around $109,000. Without adding any additional funds and only reinvesting dividends and capital gains, your investment at the time of this recording would have grown to just under $700,000, compared to around $740,000 if you would have invested the lump sum. However, even though you'd have a lower final balance, one of the key benefits of dollar cost averaging is the psychological comfort it provides. Investing a lump sum can be daunting, especially if you're worried about market volatility or a potential downturn. You're not doing yourself any favors by investing a lump sum and then selling out low because your balance has dropped. Imagine you're an investor who started using dollar cost averaging to invest each month over the course of 2008. This was a year marked by extreme market volatility due to the financial crisis. By spreading your investments over the entire year, you bought shares at various price points, some high and some low. When the market eventually rebounded, the shares purchased at the lower prices during the downturn significantly contributed to the overall growth of your portfolio. On the flip side, imagine you invested a large lump sum right before the crash, and then your $100,000 turned into $60,000 over the next year. What would you do in that situation? Would you have the patience to remain invested, knowing the stock market has always recovered, or would you sell and lock in a $40,000 loss? Dollar cost averaging allows you to ease into the market gradually, reducing the anxiety associated with investing a large amount at once. This strategy can be particularly appealing to new or conservative investors who may be hesitant to commit a large sum upfront. Another advantage of dollar cost averaging is that it encourages regular investing and financial discipline. By committing to invest a fixed amount regularly, you develop a habit of saving and investing consistently. This can be especially beneficial for those who struggle with making large financial decisions or who tend to procrastinate when it comes to investing. And dollar cost averaging doesn't have to be an all or nothing approach. Some investors use a hybrid strategy, combining lump sum investing with dollar cost averaging. For example, you might invest a portion of your available funds immediately and use dollar cost averaging for the remaining amount. This approach allows you to benefit from immediate market exposure while still mitigating some risks associated with an immediate market downturn. So, while dollar cost averaging can reduce the risk of investing before a market downturn, it's important to recognize that it might also lead to lower returns compared to lump sum investing in a rising market. However, for many investors, the trade-off is worth it for the peace of mind and reduced emotional stress. When deciding between lump sum investing and dollar cost averaging, here's a key statistic to keep in mind. Over any 20-year period in the history of the S&P 500, the market has never delivered a negative return. The average annual return of the S&P 500 since its inception has been around 10% at the time of this recording. Even during the worst 20-year periods, the S&P 500 has still provided positive returns to investors who remained invested. No matter when you started investing, if you stayed invested for 20 years, your investment would have grown. For instance, if you had invested in the S&P 500 in 2000, right before the dot-com bubble burst, and held on to your investment through the 2008 financial crisis and beyond, by now, you would still have seen substantial growth in your portfolio. So, what does the data tell us? From a purely logical and historical standpoint, lump sum investing tends to outperform dollar cost averaging. A well-known study by Vanguard compared lump sum investing to dollar cost averaging across various markets and time periods. The study found that in about 2/3 of the cases, lump sum investing outperformed dollar cost averaging. The primary reason is that markets generally trend upwards, so investing earlier rather than later tends to yield higher returns due to the opportunity cost of holding cash and missing out on potential gains during periods of market growth. But even with this knowledge, investing decisions are often influenced by emotions. Fear and anxiety during market downturns can lead investors to make impulsive decisions, like selling their investments at a loss. Dollar cost averaging can help mitigate these emotional responses by providing a structured, consistent approach to investing. It allows investors to avoid the stress of trying to time the market and reduces the impact of short-term volatility on their investment decisions. So, which strategy do I personally think is best for investors? Both lump sum investing and dollar cost averaging have their advantages and disadvantages. Lump sum investing tends to offer higher potential returns and simplicity, capitalizing on the long-term upward trajectory of the market. However, it could come with psychological stress, particularly if a market downturn occurs shortly after the investment. On the other hand, dollar cost averaging provides a structured approach that reduces the risk of investing at an inopportune time, offering emotional comfort and promoting financial discipline. But keep in mind, it may lead to lower returns in a consistently rising market and could add complexity to your strategy. Like any financial decisions, the choice between lump sum investing and dollar cost averaging depends on your personal circumstances, risk tolerance, and investment goals. If you're confident in your ability to withstand short-term volatility and have a long-term investment horizon, Lump sum investing could be the right strategy for you. However, if you prefer a more gradual approach to mitigate emotional stress and market downturn risks, dollar cost averaging might be a better fit. Ultimately, the best option is the one you'll stick with over the long term. Whichever option allows you to start investing immediately and helps you to stay consistent with your decision is the right option. The most important thing is to have a plan and understand how your decision will impact your future. If you're wondering how this decision or any other financial decision you're facing might impact your financial plan and goals, visit thehourlyadvisor.com and schedule a free consultation. We'll help you understand the best strategy for your unique situation, taking into account your risk tolerance, investment horizon, and long-term objectives. And if you found this video helpful, don't forget to like and subscribe, and share your thoughts and experiences with lump sum investing or dollar cost averaging in the comments below. We'd love to hear from you.